Hello, everybody, and welcome. I'm Bonnie Helper. I write the weekly Startup One Step newsletter. I'll put it in the chat. And we cover technology and also provide useful links for founders. And every 2 weeks, we host an online investor insights with one investor and a small self-selecting group of entrepreneurs. I also work with founders on their pitch decks because you guys just don't know how to write pitch decks properly. You just don't. And then I make introductions to strategic partners or investors where and when appropriate. And I want to thank Joseph for hosting us. Joseph,
Thank you.
introduce yourself.
Thank you, Bonnie. Welcome, everyone. Good morning. Joseph Katz. I am a startup marketing guy. I've built my career around results-driven marketing. I've worked in corporate America and early stage companies. I was part of one early stage company that had a exciting exit a few years back. And for fun, in addition to doing this, I co-host a podcast on aging and longevity. So I'll put all my contact information into the chat. Everyone should feel free to do the same. And I'll put a link to all the previous recordings as well.
And this week, our guest is Landon, who just changed the name of his fund, as I told you all in the email today. So, Landon, it's up to you whether you want to go around the room and have the attendees introduce themselves, although since they seem to be, meandering in slowly. Do you want to talk about yourself first and tell us about the fund? I know why you pivoted, and or do you want them to introduce themselves so you know who's in the room? Up to you.
Yeah, I mean, I like the interactive nature. It's a small group, so I'd love to kind of hear who's out there and learn a little bit of the audience.
Okay, so Danny, new boy, Danny, take it away.
Thank you. I feel sufficiently welcomed. I live in New York. I work for Comcast. I work for a consumer investment group called Forecast Labs. We don't write checks, but we help grow emerging consumer businesses by running TV ads on their behalf. We don't charge them for the inventory, but we do the attribution afterward to prove that not only did our ads run, but that we successfully sent them revenue. So we have a first of its kind earned equity model that we only get our equity on the back end of about 2 years of running their ads once we hit our performance goals measured in revenue to those companies. Make 5 or 6 investments a year. We, as I said, don't write checks, so we don't have to come in at a fundraising round, but we do want to find our businesses that are poised for scale and need our mechanism, aka TV advertising, to help grow the business, both in terms of volume of new customers, but more importantly, to drop their customer acquisition costs significantly over time in comparison to what they're used to spending on Facebook and Google.
Oh, thank you. Yeah, we try to keep the intro short. Thank you. Nick, take it away. And welcome back.
Yeah, I'm actually on time this time. I didn't have to cut in the middle of it, but yeah, I'm with a company called Insperity. We work with startups and small businesses, full HR outsourcing, compliance, benefits, the HR, technical and strategic side of things. But I'm also plugged in with the VC space, a couple of VC groups up in New York and down here in Philadelphia. Really just looking to be here, hear some insights, get some, where the market's at, and be as valuable as I can to the folks I'm talking to.
Oh, thank you. Fanboy Ray.
Hey, I will say entrepreneurial does age people, at least me. So doing that, launching a platform that moves digital assets entirely over the internet. So really the two main purposes are disintermediating credit cards, basically allowing those significant costs to go to merchants and consumers rather than Visa, MasterCard, and Apple. And 2, we're able to attach digital assets like videos directly onto products, creating very good consumer engagement experiences. Thanks for having me. Thanks for talking, Landon.
Thank you. Robin. Oh, you're muted right now.
Yeah, I am muted. Hi, I'm Robin. I'm in New Jersey. I help B2B tech vendors work with analyst firms like Gartner, Forrester, IDC to help them grow their business. And that's something that startups don't play in that field, and they get outmaneuvered in the market. So I help them do that, get benefit for very little money. That's my secret sauce.
Thank you. Deborah.
Hi, everyone. I'm Deborah Lee. I'm a business partner with Bonnie, and we have a consulting business, Debonair Consulting. We help founders prepare for investments by helping them with their investor materials. So their pitch decks, executive summaries. We also introduce them to our network of investors.
And strategics. Craig.
Morning. Hi, I'm CEO and founder of Homesy. Homesy is the first consumer-to-consumer social home discovery network. It's like LinkedIn for real estate, really. It's ad supported at the beginning, but has several progressive revenue streams, including home sales. But because we are actually outside the brokerage system, our fees are under 100 basis points. We allow brokers to come in and be part of the platform, but not to sell.
Oh, thank you. Mary Queen of Scots. I'm sorry, I couldn't resist.
Usually I'm the queen of sound bites, having been a former videographer.
Oh.
Hi, guys. I'm Mary Scott, originally from New York, currently in St. Louis, and consulting with startups, mostly early stage, to help them validate their ideas, learn to pitch successfully, and get money from investors. Currently working with a great community to put together a comprehensive resource hub for startups in St. Louis. And yeah, it's talking about community members and finding out from startups what it is they need to make sure we can fill in the gaps. This is a big project, and I'm real happy to be working on it.
Yeah, sounds like a big project. Sandra.
Good morning, everyone. I'm Sandra Connor, and Video Grows clients benefit from working with me and my company because we are objective driven when it comes to using videos for their marketing. This is not a videography company. We are a video marketing company that stresses returns on their investment. Sandra Connor, videogrows.com.
Oh, and feel free to put in the chat too. Ken.
Good early morning from Seattle. I'm Ken Deering, CEO of iGuard Home Solutions. 30% of Americans by age 60 have cognitive memory issues, and we protect them from forgotten cooking events so they can safely remain in their home.
Oh, thank you. Mark. You're muted right now.
Sorry, hi. I am Mark Gold. I'm the founder of the first non-equity accelerator program in New York City called 2020 Startups. I also, for the last 5 years, have been creating accelerators and innovation programs. I'm kind of at the intersection between government tech and innovation development. And the program that I created, we've commercialized over 300 companies from over 25 countries. And yeah, I'm excited to learn a little bit more about SPVs and learn a little bit more about how I can galvanize my community into creating an angel network.
I mentored a few accelerators, all of whom you've heard of too. Ian, it wouldn't be an Investor Insights without you, Ian.
Yeah, good morning, everybody. Ian Garmaze. I'm in Toronto. I'm the COO of Virtual Film School. We are a live online school for content creators, currently doing business in about 4 countries and soon pretty much in the US, I would say, within the next 3 months. So that's our current goal.
Oh, thank you. Brian Hurd. Oh, you're muted. Or maybe multitasking. Eugene. No? We'll keep going. Andrea. There we go.
Hi, good morning. Recovering attorney, work for a family, but also close with quite a few American family offices. We've just been trying to figure out what's investable in this space, especially with AI and against the backdrop of AI. Good to be here. Thanks.
Oh, thank you. Ryan Pearson. And you're muted right now. I guess you guys are multitasking right now, and happy to come back to you later.
No, hold on, wait, I'm here. I'm here.
Oh, Brian, I know you always speak up. Go ahead.
I'm just trying to get my okay. Am I all right? Hello. Sorry. It's early and I'm happy to be here. And also hello, Landon. I've known Landon for like quite some time if he's here somewhere.
Oh,
So my name is Brian Pearson Jr. I'm the CEO of ED Rain. ED Rain is a college housing rental marketplace provider for colleges, providing housing for solutions for both on and off campus housing, so their students can find roommates, housing, and build credit, paying for rent both on or off campus for free. Colleges can manage their own campus housing stock and collaborate with private owners within 10 miles of the center point of campus, so they can manage their students' housing life cycle in college. And we're raising $1 million, and we already have over $3 million in soft commits, and we should have about $200,000 wired in the next 2.5 weeks. And we are still looking to add to our lead investors soft commits, because we have we have like 3 university-backed investors that are investing in this round, and they would love for us to have a lead. And yeah, so cool. Thank
hey,
you.
Brian, how many schools are you in now?
So we're in talks with 30, but we have 4 signed.
Okay. Good on you. So,
Yeah.
Thank you.
Landon, tell us about yourself and your background, and why. And I know why you decided to change the name of the fund, but the floor is yours.
Yeah. First off, I'm always one that is open with my network and conversations of help. Brian, I'm putting someone in the chat that you should connect with. Very strategic group. They sell furniture and mattresses specifically to college students. So, yeah. I'm Landon Ainge. My background would probably be too long for this session that we have this morning. I know I look 17, but I feel like I've had about 5 different careers. So to go through the Reader's Digest version, statistics undergrad, I was going to be in the professional sports space. I had multiple offers to go work in that space, Moneyball, before Moneyball was cool. And I decided that work-life balance was horrible. Sports is great as a passion, not that great as a job, if you're wondering. And I decided to go take the corporate job. I went down the Goldman path, got very bored quickly after being at Goldman, went to do M&A transactions in boring industries like trucking, railroad services, marine transportation, environmental services space. I did about 15 different transactions, over 450 million of acquisitions. That's where I really learned business. I didn't take a single business class in college, I'll be honest. I was a numbers guy, and that was amazing. I got to meet with, one of the greatest generations of all time, the baby boomers, and how they built companies and learn their process. Also understand the importance of timing. It's very important, as many people of different generations are learning. Timing is a very important thing. I shifted to the tech world. I managed a mobile application for a publicly traded company, Overstock.com. They were the only profitable e-commerce retailer out there. They were profitable for 16 quarters before Amazon got there. We launched augmented reality when that first came out. We were the first e-commerce platform to accept crypto. So I got to be kind of on the bleeding edge of technology. But more importantly, they thought the mobile app was their worst asset in the company, that we were the ostracized stepchild, and I ran the whole P&L. And so I got to watch that Zoom, or I should say, bring to light that Zoom through my team. And we, 5x our growth in about a year and a half, just by fixing the leaky bucket of retention. I joined the venture firm because I didn't understand it. I understood profitable businesses, I understood technology, but how you could invest in companies losing money, and expect to make money, that concept actually just didn't click. So like a crazy person, I decided to jump in and join a fund to learn about it. And I got very comfortable with the risk tolerance very quickly. And as an analytics person, I evaluated, what made venture different. Ironically, I was fired from that venture fund. I like to bring that up just because it's an important part of life. Like, most of my best friends, the best ones I've done best in business, have been fired appropriately. So I thought, I was going to work for another VC fund and bring them to the middle region of the US and give them access to big deal flow. But I learned that venture is pretty closed loop and they all think very similarly. And so if one fires you, you're not getting a job in it. So I joined a startup. We ended up creating a cell phone network for kids, trying to introduce technology in an age appropriate way. So kind of like a starter phone, I think is a way to think about it. We were trying to get parents to delay the introduction of smartphones because it was destroying the minds of our children. And so we went to 0 to 2.3 million revenue in 12 months with no VC funding. We raised from private individuals only because no VC would back us, funny enough. And continued to scale there. I ended up seeing that my vision was very different despite running the day-to-day and running the company. My vision was different than the CEO that would fly in once a week. And so as a co-founder, I stepped away and wanted to move back into finance. And that's when I started a syndicate, right in the perfect time, right at COVID. So somehow I decided I wanted to be an investor and not ask for permission, and started my own venture syndicate in May of 2020. And so I was used to getting started digitally, and I didn't know any different. So I leaned all into everyone else's delays and failure. And yeah, I worked for the largest SPV administrator in the country. They were named Assure. They were the back end of AngelList, and they were basically helped make AngelList function by doing the legal and accounting and infrastructure. And yeah, I slowly, I basically convinced them to pay me to be an employee, but to be a customer and teach people what SPVs were. And so I became the SPV expert, and that was awesome. I took on that role with the commitment that I could do 12 deals in the first year and 24 in my second year, having never done a deal of raising capital in my past besides my own company. And that was a scary time, but I was able to accomplish that. We were able to do 20 deals in the first year and about 40 or 35 in the second year. Over that time, 2.5 years, I did 65 venture deals, where I was matchmaking founders and VCs for free and then helping individual investors invest in that space. So that's way too long. Assure ended up failing. So we can talk about what's happening in the SPV space. I know that very, very well. I'm probably one of the 3 most experts in the country about what happened and what to do if you're starting a syndicate. But I'm to the point now that I've been seeing about 250 deals a month, and I'm tired of waiting for permission to invest in the deals that I believe in. I'm a GP. I'm not a community manager. I'm not a supporter. I'm not an advisor. I'm an investor. And so Between the Coasts, which is the venture fund that I am currently building, is focused on those underserved tier 2 markets in the United States, because I believe innovation actually comes close to where the industries are developed. And so if you're looking for where innovation is going to come from, it usually comes from within the corporate environment, but the corporate environment doesn't support it. And so those people leave and they go create it. And so when we're talking about, major wave implications, someone mentioned AI, that may stem from some of the coastal markets because you see that's where many of the tech talent may be there. But when you talk about innovation of what's going to make and adopt technology into some of the more archaic industries or some of the next generation, the innovation actually comes closer to where that work is being done or where the industry hubs are. If you want to talk about Atlanta with the financial institutions there, it's very likely that you might see a fintech solution that's successful come out of Atlanta, or Boston and North Carolina, those regions that are very known for medical. Well, that's probably where you're going to see, medical innovations and new technologies come from the individuals that aren't willing to wait for corporate environments to adopt. So Between the Coast Ventures is just a seed stage venture fund. We look for companies that have a product in market, and they've kind of had to slog through that time period because access to capital wasn't a thing they were known for. So they only had one solution to go get customers. So we invest in founders that are scalable, who has products and technologies that are scalable and with a venture upside, but have a different methodology. The New York methodology is go build a really powerful board and make it look as impressive as possible, and then go get money and then go build the thing. San Francisco model is go find someone technical, raise a bunch of money, create a product, and find a market. Everywhere else in the country, it works a lot differently. Show me the traction, show me you have validation, show me people are willing to pay for it, that you know how much they're willing to pay for it. And I think that's a better way, a different way to do business. So I'm sorry I rambled way too long. I never like to talk for that long. So Bonnie, I'll kind of defer back to you of like where we should take this, because there's probably all sorts of ways we could go.
No, I did have one question, and any verticals in specific that you're focused on?
We are a generalist fund, but specifically, I would say capital efficient B2B vertical software, consumer products with defensible IP. I say that like what actually has defensible IP. We can talk about what that does and doesn't do. And then fintech piping or unique marketplaces. I view marketplaces and fintechs as huge upside, high risk opportunities, but not consumer fintech, but B2B piping in the fintech or marketplace world.
Oh, and what size checks are you writing?
500K to $1 million.
Okay, thanks. I have one more question. Oh, you had a slide you wanted to.
Oh, yeah.
Share. I did want to remind you.
So basically what I don't see that available. Oh, here it is. Share screen. So this is the first slide I would talk to when I talk to my investors, my customers, which are the LPs, right? This is how I believe the VC market works. You have 80% of the money of venture capital firms are headquartered and have them in the right here in the Northeast and in the Pacific areas. Because of that, and because venture is always looking for the leading edge, they're always investing in the same industries at the same time. And therefore, if they're investing in the same region, in the same industry, at the same time, you can understand that just the sheer arbitrage of value is that they're usually investing at higher valuations because they're chasing the same deals.
Yeah.
I love that aspect. Founders definitely use that to their advantage. But at the same time, you're telling me that the innovation is all happening in those two regions. So my perspective is that, you know, a lot of people want to talk about AI, and a lot of LPs do. The reality of that conversation is 95% of AI companies right now are going to die, the ones that are built. And openly, AI is innovating so quickly that most of them are technology searching for a market, not a problem. And so if you really are looking at an AI company or someone that knows about AI, you have to look at what matters. What matters in AI is not how the AI works or how you're building it. What matters in AI is that you have differentiated data that informs the AI differently. You have access to data that no one has, and you're building a database. Or that you have a middleware that makes it more easy to use, or that you provided unique insights to a specific vertical industry that's there. So venture oftentimes is just searching for a problem, when in reality, these problems have been identified closer to the industries, which is, I believe, the mountain region, the Midwest region, the South region. Those regions are closer to the industry and get closer to the customers faster. And they don't have an option not to, because they'll die if they don't. So I'm just going to share that one slide. I'm not going to dig in too much to, you know, what more detail of like how I'm selling myself and how I'm, you know, talking to LPs, but that's my belief. There's a lot of FOMO, and, you know, my personal mission and belief is that the people that are greatest at creating FOMO are often the largest narcissists in the world. and we keep allocating more and more money to the largest people that are actually not promoting a positive world. And so, I get it. It's our emotion. We don't want to miss out. That is the emotion associated with investors. But we need to instill, and we need to allocate capital to those individuals that have genuine ability to not be affected by that, and actually want to back those individuals that will bring positive change to this world, and get great returns in the process, right? That should be a and situation. I'm not an impact-oriented fund, but we should talk about what's wrong with our industry as venture capitalists. So that's just my ramblings, and I hope that there's some insights or something we can talk more about.
No, I was going to ask if anybody has a question, although Brian posted one in the chat. He wanted to know, do you lead or co-invest, or do all the above?
Typically, I mean, for capital efficient, $500,000 to $1 million can lead a round. But the biggest risk for a venture capital fund is that you either don't raise all of your round, or that you don't raise your next round. That's the biggest risk for someone like me. And so I have to make sure that I feel comfortable in that situation. So I'll lead or co-lead. I love working with other VCs. That's half my model, is bringing in another VC that I like. I actually prefer not to sit on the board, because I'd rather bring either one of my LPs who's an expert in the board, or I'd rather bring a VC that's a specialist, because I'm a generalist. I like to bring in someone that's been in hardware, or someone that's been in unique spaces, because I'm investing in unique opportunities.
I asked that because Stanford AI Fund reached out to us after we just finished Techstars, which is crazy. ED Rain's a Techstars company. And we strategically did not show up on Techstars Investor Reveal until after the program, because I was like, look, if you're gonna hit the investor reveal, you should do it after you finish the program, not as soon as you get in, because it's kind of dumb. And so when we hit the investor reveal, Stanford reached out and they're like, look, we'll give you $75,000 plus we'll give you access to free interns and stuff on campus. You just need to have a lead. And so like we do have a couple people interested. I2E and Plains Ventures in Oklahoma, but that's two organizations coming together to lead around versus just like an organization. And like, so that's why I asked that question, because there's other funds that are little checks. I guess I'm saying 200,000 will close in 2 weeks. But
you have a lead established, right? So this is a very common problem for what I would call the tier 2 cities, right? Or, if you want to consider that, I would consider a tier 2 city as being regions that have had, 3 to 5 generations worth of startups, right? Where there's been iterations. You can look at kind of what's gone there. And that shows that the ecosystem, they've learned the behavior. If they're tier 3, then they're kind of in that 1 to 2, like first generation of successful entrepreneurs that are going down that path. And what happens in those regions, there's usually like 3 to 5 VCs that are actually deploying capital that will lead. And what often happens is those VCs will invest in the same deals oftentimes. And so just because the 3 VCs in your region say no, doesn't mean that's there. And there's a lot of other players that are like, I like your deal, but you have to get the validation and the check mark from an institutional lead. The reason why they've gotten that way is there's 2 reasons. Those smaller groups, usually they're either saying that they don't know how to identify and get involved in the company to add value. And so they're writing a small check. The second is like, the reality is they're probably just not able to fundraise large enough in order to have a fund to dictate that, or they're an individual family or institution that wants to do so. And so this is very common for founders in between the coast markets, that they have traction. They've done everything that every institutional investor has told them they should do. And then they can't find someone that has a conviction to say, I'm in, right? And that's where I typically am trying to come in to say, I'm in, and I want to bring another lead with me. So then you can fill in the gaps as the founder, right? Or we can set up an SPV to bring strategic individuals to fill the rest, or whatever mechanism is there. And that's why you have so many groups that want to follow. They all want to participate, but there's this barbell. There's lots that want to follow every lead, and there's lots that want to like fund you at the Series A when you have $2 million of revenue, and there's very few in the middle that are conviction-based independent thinkers. And so, you know, I believe smaller funds are actually the answer to this problem that we see, because smaller funds realize that upside and they recognize and are willing to take bigger risks. For LPs, smaller funds historically have had a better return. My fund's $40 million. That's considered small. I'm still going and talking to LPs to convince them of this fact. But, you know, there's a lot of unique insights that I think I've observed from the number of deals that I've done. So
that's funny. That's fine. I'm sorry. I'm just thankful for that, because that's exactly the playbook that we have deployed, like on all levels. Like, cool. Well, I thought you were smart. So like, I'm happy that great minds think alike.
I don't think that this is particularly unique, that I'm necessarily like, I have a unique insight that no one else has. I mean, I've seen a lot, but, you know, you could apply my thesis to a lot of different people, and I think that many people could execute. So I hope there's more people like me that have this thesis, and there should be 20 more funds like me that are focused on these regions. And I think that there's a benefit to focus on lots of regions rather than just one, because I will see deals that, you know, in Chicago and in Atlanta that are trying to build the same thing. And it's really important for me as the investor to compare and contrast the two. I have to be honest and make sure I'm not, you know, sharing information about either one to each other. But it's important for me to make sure I'm making the best decision for my investors. There are so many people in Atlanta building the same thing as people in Chicago or in Utah or in Texas or in Charlotte. Like, so many people are going after the same problem. And oftentimes they probably should just be connected and build it together. Once they've failed enough, then I will oftentimes connect them to each other, because when they're early on, they think, no, I can do this, I'm doing this. But once they've seen a little bit of failure, they realize resources and skill sets, those can be married very well.
Right, I've done that too. Somebody have a question?
Well, I'll ask one. So on this call and some other investor calls, there's been some very negative comment recently about the state of the venture capital sector. But, you know, availability of capital seems to be dramatically reduced. I mean, what is your opinion right now on the state of the venture capital in general?
Yeah, so there are three different things that I would say. So you can have different perspectives to say, is venture capital a great asset class to return money right now? I would 100% say yes, for LPs and people, individuals allocating. But the LPs are feeling a certain pain of liquidity. Real estate deals are taking longer. There's less debt available for those opportunities, and therefore they're having to fund more in equity into the real estate deals. Private equity is taking longer to go through this process. Those are the impacts from the interest rates that we're talking about.
Yeah.
Also, additionally, you would say, you know, these VC deals are taking longer to exit. We have had a historical low of IPOs and conversations. So all of that to say is, like, the LP pain point is on liquidity. Now, some of them are become more liquid than they've ever become in the last 2 years, because when things go poorly, you know, generally people that have control win, and those that don't, right? That's the economic diversity conversation. So I would say, if we're looking at a high interest environment and we're looking at not that many people deploying in venture, this is the best asset ever. This is the best shield from inflation. This is the best upside perspective ever to invest as an LP, this next tranche. And I truly believe that. That's why I'm betting my career on it, that I'm raising capital right now. So right now, you should totally be investing in venture if this is your conversation. Where you shouldn't be investing is the pain point of real estate development and multifamily, unless it's a specific microcosm of a geography that you believe in and an operator you believe in. But that's because the cost of debt is so high. So you need to provide such great value and guarantee that you're going to fill it up. Or in private equity, you no longer can just use financial engineering to buy a company super low because competition's high to buy companies, and use debt to lever it up. So when we're comparing across asset classes, it's not even a question. When it comes to what's happening for the existing venture firms and what they're doing, volume is down significantly. Series A is down about 40% comparatively. Even seed has seen an impact and down about 20%. I'm very surprised that seed investing historically has been very resilient, because when you see a slow at the late stage, you typically see a shift that later stage funds will make smaller bets early, because they're like, well, we've got 10 years to figure it out till they actually exit, or 7 years. And so it's a shield or a hiding place where people will put money. So that's been rare that I've seen such a slowdown, but I think that's more to speak to people's liquidity. Some LPs over allocated to venture, like in the last 3 years. We were also in a crazy time. Like 2021 was unprecedented with the amount of venture capital deployed, and deployed unresponsibly is kind of my perspective. Andrea, were you going to say something?
No, sorry, no, actually, I don't know.
You unmuted.
Oh, sorry. I think so.
Oh yeah, totally fine. So yeah, I mean, I've been very surprised at what I've seen historically, but you know, that's the reality of where we're at. I've seen more bridge. I can get into any bridge round I want in the whole country. I would say about 40% of those that raised venture capital in the last 2 years are currently raising, and are currently raising on equal terms than they raised before or less than. So if you're a new venture fund, new venture opportunity, new startup, that's what you're competing with. And if I'm a existing venture investor, I'm trying to evaluate what is currently happening. Do I want to invest in my existing portfolio company, or do I invest in a new one? So that's kind of the microcosm of what's happening in venture at the early stages. Again, I'll reiterate, I think that allocating to venture right now in those that seem to have access, it's a great answer. And I'm not saying that because I'm doing that. I'm saying that, like, find someone you trust that has some sort of unique access to deals that founders will want to take their money over other people's money because of the way they talk or because of their expertise or something. And I would totally get to that. So that's my message to LPs. And as a founder, you have to be dating your VCs just as much as they're dating you. So ask questions. Like, your job is to spark interest. Let's be clear. Like, that's on you. And then once you have some interest, it's okay to ask questions after the first 20 minutes. So rather than take 30 minutes to present your company, take 10. Let them ask questions, and you ask questions. That's a much better conversation for you and them, rather than taking the 30 minutes to talk about your company.
Well, that's encouraging. Thanks. I mean, in our case, we're not really talking to VCs. We're talking to strategics, because of the connections that we have, and it's hard to get a read on things. But I appreciate your analysis, because it's like you put it into a larger perspective than I've often heard. So that's helpful.
I don't know how people don't. Like, I'm surprised at how many of my venture friends don't understand real estate. I'm like, well, that's really important, because my customers care a lot about real estate. So I better understand a lot about real estate. My customers are LPs. They care about what's happening in liquidity markets. They care about what's happening in interest markets. I want to know what's happening in private credit, because that's where I see the other opportunity right now is private credit. Venture and private credit are the areas that I would be personally investing if I had billions of dollars, and it's where I'm investing personally.
Right, but real estate would seem to be a world of pain right now. I mean, there's vast potential for problems. But but it's an interesting way to look at it. I appreciate it. Thanks.
Landon, quick question. Thanks for all that great insight. I'm taking some notes here. When you invest, you've obviously made a lot of investments, probably more than the average early stage investor. What do you look for in the founders or co-founders when you make those investments?
That's a great question. I mean, I never answer a question right away because it's great, but it's usually coming from a place. I'll take a step back. I would say the founding team at the seed stage is about a third of the value that I would allocate to my evaluation of a company. So just to put that in perspective. And then what I do evaluate, like I talked about, it's kind of a little bit of an obsession with what they're talking about. Call it an intellectual curiosity that they're constantly it doesn't matter who they're talking to, they're trying to identify, is this a potential customer? Is this a potential strategic partner? Getting their thoughts, right? You can tell they're able to guide the conversation in that way to understand whatever they want to understand. And then usually that's not with me, the investor, it's with their other interactions, or it's with how they talk, right? When you hear me talk, you know that I'm not just a tourist in venture, that I'm raising money in venture because I think this is cool, or oh, I'm gonna get rich, right? I think about venture every day of every minute, and I'm diversifying my knowledge, but it's because I'm poking and prodding around the space. I want to hear the same intellectual curiosity from a founder to know, do they understand their customers? Do they understand how much they're willing to pay? Do they have insights? Don't tell me you're waiting to raise marketing dollars to determine how much people are going to pay. Tell me you've interviewed 1,000 people and you know that about 30% who you're targeting are probably these people between 70,000 income and 90,000 income to go through that. Or if I'm Brian's on here, right? I want to know what schools he's going after. Why is he choosing those schools over these other schools and prioritizing this one over that one? If it's just because they said yes, that's fine. But I want to know, well, this one has the fastest growing population or fastest growing enrollment compared to this one's going down 30%. I now know that in sessions there. And they're thinking about the monetization model. For me, the other piece that I would say is they understand their weaknesses. I don't want to hear, maybe it's the operator that I was a co-founder. My perspective is I don't want to hear everything's not roses as a startup. It's actually usually more going wrong than it is going. That's okay. Your job is to present the positive scenario to the investors. And as the investor, it's my job to find the worst case scenario of what's likely going to happen, which means you probably die. Okay, great. We both established there's huge upside and you're probably more likely to die than you are to not die. So what are the reasons you're most likely going to die? How are you addressing that? Okay, you're not that technical. Great. How are you thinking about solving that problem? Well, I have outsourced development and we need to get to this point of revenue so I can attract more capital. And at that point, I'm going to bring in a technical team. Wow, you're really thoughtful about what you're thinking about here. It's not just well, I'm going to figure that out. I'm going to figure that out. There's some really key insights that you can get when you hear founders that they're planning for success. What we plan to do is we're doing this to accomplish this because we understand that that's the threshold that we need to get to at Series A. We need to have $1 million in revenue. We want to get to 1.3 million in revenue annualized. Demonstrating those data points, you can kind of hear it in a founder. This is why you hear the insight from VCs, why they keep backing successful founders. It's because of how they talk. It's how they talk about the success they're going to see. And so my perspective is, your question is how do I evaluate founders? It's how are they preparing for success? Not what if success happens? It's how are they preparing for success? I'm building my fund and I already have the structure of how I want to build my team for fund 2, right? That tells you something that I know the process, which most first-time founders don't. So you need to surround yourself with people that have done it and get enough insight into how it actually works. And 2 is I'm going to make that happen, and I'm assessing to a degree that, like, I hope that it's a believable story. I'm going to get there. So, and then the other thing is founder dynamics. If I want to ask honestly what they disagree most on, and usually bringing up those things, those problems, right? Like bringing up the things like, if you guys were to die, like, what are the 3 reasons you're going to die? Oh, we're dying because we're underfunded. We're doing this. We're doing that. Okay, what are you guys doing? What do you each believe is the method, like, to approach that? You can see really quickly they may disagree and how they interact with each other, but disagreement's a good thing. That pressure tests solutions or approaches. And so the question there would be, like, if they can disagree and be fine, that's a good thing. If they won't address a problem, that's a bad thing, because that's a divorce waiting to happen. So those are the things I look at founders: obsession, planning for success. They think they're just poking and prodding around the problem, and then the relationship with the co-founders are kind of how I think about it.
I love the planning for success. Yeah. You're not thinking about how you're gonna get there, you're never gonna get there. So I love that.
Yeah, first-time founders very much focus on like what you've done already and like what you're going to do. If I'm honest, if I'm a seed investor, I'm investing about what you're going to do in 5 years. Like, I have to de-risk myself that you're going to get there. But if you give me enough data points, it's a believable story that, like, you're going to get there. What I really care about is that you have enough upside for me to justify investment. And most venture founders trying to raise venture just don't, they're not big enough. So someone asked what else I evaluate besides the founders, because that's like about a third. What every VC looks at, and there's probably like 7 things. Go down a checklist of like what they look for, and that one I just addressed. Is it a big enough thing that it can return my whole fund? So if I invite $500,000 to $1 million, so I have a $40 million fund. So that's a really helpful math that you should think through when you're talking to your venture investor. It's how you try them out. If I invest, do you have enough upside to return their whole fund? So if I invest a $500,000 check at this valuation, from that valuation, can you go 20x, 100x? If it's not more than a 10, you're definitely not venture backable. If it's not more than a 20, you're probably not venture backable for most VCs because their funds are so big. And so that's definitely one. That they say market size, that's essentially what they're really asking is, can you get that big enough? That's the real logistics. The other things, I mean, it depends on the industry. My answer changes depending on the industry. So I put traction in there, points of evidence that demonstrate that you're actually able to know your customer, get to your customer, have some sort of validation around that customer standpoint. Not every VC has that. Some will invest pre-product, but you decrease the number of funds that are willing to talk to you if you're pre-product or pre-revenue. You know, gosh, being on the spot when you ask those things is always an interesting conversation.
It sounds like you're really asking for someone to be able to describe their vision of where they're going and how they're getting there, and how well they know their market. Right? If they can answer those questions in 10, 15 minutes, you're going to be interested.
Yeah, I mean, the 2/3 of the other things, there's probably a number of others. Unit economics, if it's an industry that makes sense to look at. If it's consumer products, it's your CAC to LTV conversation. If it's B2B SaaS, it's how are you thinking about getting to those customers? Is it channel partnerships? Is it directly? Is it a sales force? How do you actually contact your customer? Like, those are the things with sales I want to know. Like, I don't care how big the market is. I'm going to ignore that. I'm going to care about how many of them can you actually get in touch with. Is it trade shows? Is it in person? Is it we have a list? We know who they are. We're testing how to get to them. Like, most seed stage companies die because they don't know how to get to their customers or get them to say yes. Those are the only 2 things that matter, I believe, like at that stage. Now, I'm a different type of venture investor. I'm a capital efficient venture investor. So I'm not investing in the Facebooks of the world. Right? Like, Facebook had a 1200x return for their initial investors. I'm not going to get that amount of upside in one of the deals. but I'm probably going to get some 200 to 300 X's, and I'm going to look like really smart in that situation. But I'm also increasing the likelihood of success because of the type of companies that I'm looking for.
Mary, do you want to ask your question? You're muted right now. She put a question in the chat.
Yeah, sure. How do startups find you? And how do you find other VCs to join your fund?
So no VCs join my fund.
LPs.
So it's very important to understand how VCs work. Very rarely, like less than 1% of the time, would a VC ever invest in another VC, because that would be them admitting that they don't know how to get access to the founders, and their customers are giving them money and paying them salaries to do so. So most funds probably wouldn't ever invest in my fund. That'd be great. But even if they do, it's going to come with strings attached. Hey, we're a Series B fund. We want to invest in you. You got to give us all of your data, and we're going to invest $1 million in your $40 million fund. Is that worth it for me? That's a debate. So that's kind of conversation. I do build relationships with Series B funds because I want or Series A funds and B funds, because I want the companies I invest in to have a potential path. But that's only if I bring it to them at the right time and it's the right traction and they're there. I have to build that relationship of ramp. Hopefully that I can build that for my founders, but that's more of like a nice to have. Better thing is just invest in good founders that have growing revenue, and then that problem solves itself. How founders find me, ironically, like I don't do anything to have to do that. Like, I think that's the answer to the question. Like less than, I'm making up numbers, so please don't quote me on this one. But like less than 5% of the founders that are trying to raise capital successfully raise capital. So if you put out a shingle that says, I give out money, people will come, right? And so like, if you're a founder looking for money, then you come. I see 200 or 250 deals. That's just on like LinkedIn. And I haven't even publicly disclosed between the Coast Ventures, because I'm still focused on my standpoint of filling like offers to be able to then deploy. Like I already have too much deal flow for that. And that's the pain point of every VC out there. They have too much deal flow, but not enough qualified deal flow that fits what their thesis is. Like if a founder reaches out to me and they're like, I have no revenue, I'm like, thanks for reaching out and not reading my website or not listening how I invest, but like, you're not my customer or you're not going to be an end user. So yeah, I would say making sure you're reaching out for the right reasons or in the right way is important.
What's the most interesting company you've found recently?
So this one breaks the mold of my fund, and I'm not investing out of the fund, but I did do a syndicate for it. That's why I'm bringing it up, because it's most interesting, because it's weird. There is a company that does a dissolvable plastic. It's a plastic that biodegrades, and it degrades in water and heat. And so you can dispose of it in the existing landfills and it has no environmental impact or there. So I've invested about 300,000 from the syndicate. I have another 700,000 that I can invest in the next, 3 months. But I'd be bringing investors into an SPV to invest in that deal. I think it's fascinating because they could change the whole world of what we're doing. Single-use plastics are outlawed in Chile and British Columbia, Canada, and regulations coming whether we like it or not. And this is technically not a plastic, but it functions and it's stronger than a plastic. They even have a fabric that's associated with it. I don't think it's going to be used. I wouldn't wear something like this, but like I'm testing it. I'm thinking about how strong it is. I'm putting it in water. I'm drinking the water after I dissolved it to test out on these things. I think it's fascinating.
But
so yeah.
If it dissolves in water, how would it hold water? You said it dissolved. Excuse me?
It's a great question. That's what makes their IP. They're an IP shop more than they are a marketing company. And they have a few products of their own, but they're actually a licensing play to, again, give this to manufacturers that could scale. So I think that one could be a fund returner where I'm investing out of 20 million valuation. And if they do the $8 million they project to do this year, I'm going to look like a genius that I got that valuation, or I'm going to look like a fool because I invested in a company that, you know, has low revenue and figures it out. But I'm going to bring some, I'm weird. I'm probably going to bring some value and bring some customers and see what happens. So that's fascinating to me.
Yeah, it is fascinating. The next question. Somebody else have a question?
Brian asked a question earlier. How do I feel about startups that launch new products and change their revenue model and see significant traction? So that's very biased because I'm pretty sure it's about your company. But let's just say like you're a startup that's like doing something and then you change and you see significant traction. That's awesome. It's kind of hard to change investors' minds. That's been my experience being on the other side of the table as a founder. Like they would say, oh, when you have this level of traction, come back to me and let's chat. And then I'd be like, boom, okay, did it in a month. We should chat. And they're like, well, like your success rate's going to be about 10%. That if someone says they're not interested right away, they're kind of probably making up reasons why they are or are not interested. And the real truth is that they will probably say no matter what. That's not always the case. And so you should update people with what's changing, what's going well, because that is the FOMO, right? I want to feel like those are data points of success. So if you can keep providing me data points of success, data point of success, data point of success, then that's amazing. But too often I hear feedback of successes that aren't real successes. We built this partnership that blah, blah, blah. That's not revenue. That's not whatever. Like I hear so much fluff in my existing portfolio companies of investor updates. Like tell me what actually impacts like your business, not just these made up highlights that we were featured in a news article. Like that, I don't care. Like that really doesn't matter. Like it can help promote if you have a reason. Their audience was this big and they really center around these type of people, then I know why you're doing it. If you're just getting in a news article that you paid to get into, then yeah, like, okay.
That's funny what you just said as I posted that, but at least we sell to people that manage apartments and we did not pay for winning that. We did not pay for winning.
No, I wasn't even referencing anything associated with your company. I was just talking about in generalities, I promise, Ryan. So for me, it was more like, I love that you're changing the model and seeing more traction. That's amazing. That's great. That's a great data point. So, you know, you should update investors about what you're seeing, why it's changing, and if they want to take a meeting, they'll take it. So I was less talking about me and more, or you, I should say, more the process.
Well, I asked that, and I'm only saying this because like these are the scary things to ask when you're going out and talking. Like, hey, I changed our business model in 2022 and kind of launched a new product in a new business model. And since then, we found a bunch of traction and we built a team and like, but I'm like, how do I talk about I couldn't raise in 2020 and 2021 and like and like we were doing something different, but now it's like our customer base, the stuff we did in 2020 and 2021, they're like, if you can redeploy that, you'll be the ultimate solution because it's a nice to have and not the painkiller. I mean, and do you get what I mean?
Yeah. So I would say like, I think you're thinking about it too difficult. Like investors want to see success. So if you're saying I'm going after this problem and I don't care how I'm solving it, I'm just trying to solve this problem. We found a better way to solve this problem, or we found that we were going after surface level pain and we found the real pain that people are willing to pay for now and we're seeing traction. That's a positive message. That's not negative. Go for it. Lean into it. Like that's a fantastic. We've actually shifted the model because we saw customers were more willing to say yes. Nice. That's awesome. Let's have a meeting. Let's catch up, right? That's typically what I would say. Craig asked the conversation about not being interested in consumer. I like consumer, just has to be something that's defensible. And most consumer can be duplicated by Amazon or Chinese manufacturers within 3 months. And I could beat them. Now it's just a a war of marketing. So
Well,
you're
sorry to interrupt. I'm specifically interested in consumer real estate, which is, and not necessarily even the sales component, but in the data and home discovery component, right? A social.
Yeah, so
like-
the reason why I say I'll answer the real question. The real question I don't like consumer, generally speaking, is 90% of or 80% of the money tends to go towards marketing. And most marketing is inefficient. And I'm not saying marketing is bad. Marketing is the answer to most of the problems.
Totally agree.
When we
And-
throw venture dollars, go look at Quibi, and we throw venture dollars to create market, or Beyond Meats is another example. Right? When we throw marketing dollars to convince users that they need this solution for a problem they don't actually have, or going back to Brian's point, surface level problems and not real problems.
Right. So that's why I'm asking you here about really about the lawsuits. So I don't know how much you know about what's going on with the antitrust suits, but buyers brokers are under deep attack, and the MLS system is potentially going to go bankrupt within the next year. There are 12 significant lawsuits. So there is a real pain point that consumers have right now when it comes to real estate. And
when I talk to consumers, I don't hear that pain point, but
they won't know about it because it's invisible to them. But at this moment, right, it's an oncoming train that, and so I'm curious to know what your perspective is about the antitrust suits and how you think they'll affect the markets, because you mentioned you have a strong focus on real estate.
So I don't focus on real estate. My customers focus on real estate as investors and not as consumers. So I don't think that my opinion actually matters. But your consumers, who I think your consumers matter, is going there. I have invested. I put a link in here. I did invest in Valia, which is basically creating its own version of the MLS, but it's more distributed way of doing so, so that Latin American real estate agents can actually promote themselves, because they don't have an MLS system. So most of them didn't have an online way to actually market what they're doing. And so that's a really interesting space there. Yeah, so I think that's my approach of it. Like, I'm going to go attack a market where there's not an existing infrastructure that I have to fight against all day, every day. So for you to figure out, like, I hear what you're saying. Like, you're very much focused on this because it impacts your business. But again,
no, I'm focused on it because it has direct impacts on consumers. I mean,
yes.
Literally the entire industry may go bankrupt. And so with that, the whole system of going to an agent, in fact, most of the big real estate agencies have already said that you will no longer be able to have commission automatically deducted to buyers brokers, and now every single seller or every single buyer must negotiate a deal with the seller for the buyer's commission, which is an extraordinarily horrible process for anybody. It really is a terrible friction point, and that's already happening. That's probably the 6 largest brokerages in the United States have all said in the past 2 months that they're paying anywhere between $50 and $80 million to the MLS, to the government rather, as damages as part of a settlement. But the 5.3 billion that was in Kansas City is just the beginning, and there are a dozen copycat suits out there. Almost the entire industry is going to be affected, and as it is, the changes will be severely felt. I see here that Brian is saying that Airbnb is killing the housing industry, and I think that there's some truth to that. Except not everybody wants. Home ownership is still the sine qua non of wealth generation for most people in this country, and we don't really have a mechanism for actually creating home discovery any longer that's not controlled by real estate agents. And they steer people, of course, to higher props. Pad split is, these are all fractional. They're not home ownership. Renting, fractional investment. Home ownership is a different can of worms. So pad split,
there's a company, Homey, that we might know of. Homey created their own platform where it was a flat fee. They got rid of all real estate agents. They almost got killed because all the real estate agents went to war against them. They were seeing huge success. They almost had 5% market share here in Utah of homes that were being sold.
Homey was interesting. But they
Yeah.
also ultimately led to a broker-led solution, right?
More on the financing side, but yes, I understand what you're saying. So I'm gonna teach you something right in this conversation. So rather than ask me, tell me, right? I'm not an expert in real estate. If you expect me to be, then you're not doing your job. Your job is to educate the investor to say, what is happening is this regulation will impact this. This is how it's going to change all of these people. This is why we're in a position to take advantage of this. And if you tell me that you're going to go to the consumers one by one, then it's not an industry I will ever invest in, and probably not an industry that most VCs will ever invest in unless they're on the coast, because they're willing to take, they want the 1200X that we talked about, right? So if you're going to kill an industry, you got to go to San Francisco or New York to raise capital. Otherwise, there's no point. No Between the Coast Ventures group, like no VCs are taking that kind of risk, generally speaking.
That's interesting.
That's my perspective. You're going to be
it totally makes sense for you. I totally get that.
for all, because most VCs, I would say, in that coastal region, because the reality is it's a different business model. It's weird to say that I have a different business model than my venture capital firms, but it's a different business model.
That
right?
makes a lot of sense. Yeah.
And so you have to think from their perspective. And then the other thing I would just say is what you should be saying is MLS is going away, and this is why. And those that, teach me why your obsession is there, that those that have these attributes will win. And this is why we specifically will go in. That's a different pitch. And that explains why you're in that position to win out in the market with what's coming, right? I just explained to you the plastics company. Regulation on single-use plastics is already coming internationally. It's only a matter of time. This company has business internationally and domestic. This is why I believe it's going to win, because they have sustainable feedstock. They're not considered a plastic, and you don't have to dispose of it in any unique way. I'm now telling you why they're going to win within a 2-minute conversation. So rather than that, that's all I know you're just asking a question, but like,
no, I'll send you the deck and you can see that's the argument it actually makes. So that's
yeah, and I've already told you I'm not the investor, right? So
I'm sorry, I didn't mean, but that is what is in our deck. Yeah.
This is what VCs deal with every day. Oh, I see you as a VC. You're the solution to my problem.
I think you're not. I know you're not. Don't worry. I won't.
No. I'm trying not to be rude. Like I really am. But I just need you to understand. Founders don't hear that perspective from VCs, honestly. And what they do is they just don't respond, right? And so I love what you're saying. I can identify probably 3 to 4 different VCs that I think would be valuable for you to talk to go after that problem.
Great. I'd love to hear who you think that if you can put them in the chat or whatever.
Yeah, I'm happy to follow up after.
That'd be great. Thank you.
No. Do you want me to share your email address with the attendees?
LinkedIn is probably the way I would go. Just because, right now I'm more focused on my own incentives right here of continuing the fundraising process than I am on deploying till first close happens. So I'll be really soon.
Okay.
Mark sent me a question directly to me, so I'll share it. He wanted to hear your thoughts on upskilling founders. Would you invest in an upskilling startup school?
So I would view that as a service company. Right? You want to clarify that? Like, is it a school to train founders on how to be founders?
Yes, it's specifically upskilling on all the different tech parts, as well as business finance, investor relations. It's essentially institutionalizing the accelerator model, but making it more available for tech founders from entry to exit. So it's a unique model. I'm just wondering what your thoughts are on upskilling and whether that would work, and just your thoughts on it, because that's what I'm focusing on now.
I think as someone who looked at starting a Techstars in my region and other accelerators and looked at the model before I did the syndicate, because I was trying to figure out how I could add value to my ecosystem. I would say one, that doesn't seem like a venture backable model to me, because it's a service company. It's not necessarily scalable. even if you do try to do it scalably, it's in a cohort level digitally. To your customer base is founders who have no money to pay for anything. So generally, and most don't want to admit that they need help. It actually looks like a negative. And three, will it actually help them attract capital, or will it actually help them attract capital, or what you should look at? So I think you're more likely to get funding from a corporation, a strategic corporation that wants to see more innovation in a certain industry, that they would pay for, sponsor the largest group for clean tech, founder accelerator, or upskilling capabilities. I think that you're solving that problem is really difficult because every founder needs different things for their industry. And so I think it's an interesting concept. You need to evaluate why it's different than an accelerator. I think a lot of these upskilling schools are doing very well. Those that upskill specifically from like customer support to SDR, right? Like I love that clear mindset because they know how to place SDRs in their field, but that's one specific role. They know exactly what product they're building. They already know they have a buyer of people that want to hire those people. Your hire is basically funders, right? If you can prove that funders want to give the founders that come through your program money, then you'll get customers. If not, founders won't go through it. So those are my thoughts. I don't think it's a venture scalable model, because then if you are, the only way to move forward is that you get equity in every deal, which has a negative self-selection. So
say that again. Say that again about
if I'm taking equity from my founders, then the founders that don't want to come through because they're giving up equity. So the founders that can just attract capital and pay for a coach, rather than those that can't pay for a coach but get equity, you're going to get negative self-selection. The people that come to you are the least likely people that are going to succeed or attract capital in the future.
Well, it's interesting that you say that because we actually have a built-in kind of like an SPV or angel group within the school. So it allows us to both serve them education through upskilling in specific areas, as well as giving them access to our community that we can like self-fund for like cherry-picked startups. So it's interesting that you say that because that's kind of the vision of bringing it together, where it's an end-to-end model. So, it's not fragmented. It's not only for early stages. It's for, a majority of about 60% of companies are international who are looking for like US market entry through, New York City, and they're looking for, those available routes. So we've had success with that thus far. And the biggest problem that we see now is that accelerators and even ed tech companies, they're very limited in terms of providing practical value. And a lot of our advisors who are, like you said, within corporations, like American Express, IBM, etc., they see a ton of founders struggling. They're saying 70 to 80% of founders are struggling. And one insight that I just got from you was that founders don't typically want to admit that they need help. So I think that might be something that we should focus on as well, making it a little bit easier.
So, you will always have an audience that will want to come to you. So that's a good thing. And you might be able to make money from them, not very much because they don't have very much money to pay. The thing that I think you need to remember is that 70, 80% of founders don't warrant getting money. It's just the reality of this conversation. I may sound like really mean, but like that's 5% of them are getting funding. I think 25% of them qualify for funding, that they could be venture backable, but like 75% of them are not ever venture backable in the end of life, no matter what happens, either because they need to figure more out until they pivot their model and then they get more, and then they're venture backable. It's not to say who they are as people or what they're doing. It might be that specific opportunity. It might be that maybe they don't understand what they don't understand. It might be lots of those reasons. So there's always a pool of audience there that will always have a pain point. The question is that a pain point that you want to be solving, right? Like that's the only thing I would just bring to light. There's a lot of people going after supporting services in the startup space. And many of those people are just like, they create false sense of validation. Like, they have a graduation program and they highlight the 3 best companies, and then those 3 best companies don't even get any money, right? Like, is that success? In an alternative application that you might think is interesting, there was a company I was looking at that did AI applications of helping people automatically apply for jobs, and I generate jobs for them that they thought would be applicable. And they could create multiple different profiles, because I could be a product manager and a product owner and a senior VP of technology potentially, and I could apply for all 3, but no system can handle that. Well, if I pay for this program, they'll automatically apply me, and I can actually get, the opposite. Maybe I can actually get some interviews, because nobody can get interviews in today's day and age because half the listings aren't real. Well, the only measure of success is, did they get people more interviews? And then did they get them a job, right? Those are the things that I view as success that would justify why people are paying for it. Well, people might be willing to pay for the service, but if I'm not getting them interviews, then does it matter at all? Am I actually solving the problem? Because eventually they're going to stop paying if they don't have enough success stories. You're selling the dream rather than actually fulfilling on those services. And so that was my conversation with that founder, to say, like, are you actually doing what you're saying you do? Well, we're increasing the likelihood. Are you doing what you're saying you're doing? Because customers tell you with their dollars and their voices. And if they're unhappy, they're going to make that known. And so I would apply that same type of thesis around yours, to say, of the founders that come through your program, how many will actually get funding? I will know, as a syndicate, I know that I had lots of people say they were interested in writing a check in syndicate deals, and I would get a deal that had a VC lead that fit the exact parameters and industry they were looking for, with the more revenue than they were looking for at better terms, and they wouldn't write a check, right? And so when you talk about funding those founders, you're selling the dream to them, but the question is, are you actually able to do so? The same critique could be used on venture studios, accelerators. Like, they should answer that question before they go start them. Venture studios are very passionate right now. Oh, they're much higher success rates, but they've been very poor at attracting future capital, like some of the worst, because most VCs don't want to invest in companies that the founder only has 20% of, or inverse, that the studio has 20% of. Like, it's a negative, it's a different self-selection. So is that the right way to solve that problem, for this industry? And it might be that might be the right way to solve the problem for a profitable business and not a venture scalable business. So, like, those are the things that I would be thinking about in your business.
Thank you.
I hope it's not, those comments that I give to you guys are not negative. It's just more how I would think if I were in your shoes. Someone that doesn't care will just tell you it's great or say no. Someone that cares will tell you why they're thinking like they think. And sometimes that's viewed as negative, but I think it's.
Oh, I appreciate it. Thank you.
As somebody who very actively mentors at several top accelerators, the game changer is always the mentors. How engaged they are, because the game, we make introductions. It's like we can change the whole game. It's not just the program, it's who's supporting them, who's really there helping them every step of the way. It really is.
Yeah, that's actually right on the money, Bonnie. Because I went through about 2 years of looking to raise our own fund, and I learned a lot about the LP process, and I learned a lot. So, my role is really focusing on that. And what's interesting is that when you said the mentors, we kind of have this like trifecta where the instructors are tech executives, they're also advisors, and they're also angel investors. So the founders have the ability to essentially triple, have a home run with one individual that they're meeting who happens to be teaching them sort of the cliff notes of that industry. So, and I also see a lot of value within bringing in the ed tech into that. So, and I've been, I launched the accelerator in 2016, and obviously COVID, it died, and then we kind of brought it back up, and now we have this investor roadshow. So, we have a 2,000 person community that's pretty strong. And for me, because I'm not from the finance or investing space, it's always been a challenge. I'm in marketing, right? I've been in marketing for 20 years. So for me, it's like, how do I kind of transition? And what I've seen so far is if you focus on the pain points of the stakeholders of the ecosystem, you can start to move the needle. So, and that's why I'm kind of wanting to learn your perspectives and hear that out. A lot of the like thought through and strategy has been based on solving those pain points for all these different stakeholders, LPs, tech executives who are emerging angel investors, as well as founders. So
I have one last question that's based off of this because, and I'm sorry, it's just based off of this. So EDU Rain just went through Techstars. We are in the final round of Generator's Butler Accelerator. Now, we would never want to do another accelerator because of the terms, but because Butler is the funder, is the LP in that fund, and they don't have an off-campus housing partner, and they specifically in their thesis said Butler is investing in software that they can use as a customer and to grow it. So we thought it was a strategic partner, and it will grow and operationalize our college business, and then we can find other investors to grow the property technology vertical, which is our sales and revenue channel. Yes, universities are our customers, but they are the contracts that allows us to make money from the property management industry and students. What are your kind of thoughts on that? Knowing that, like, you don't want to look like a startup jumping around to accelerator, but we did see a strategic value in Butler, the university, being an anchor customer with the accelerator program.
Let me ask this question. Honest question. Would you go through that accelerator if you had your lead right now?
Yeah, because Butler is the real value. Like, yes, there's like mentors and stuff like that.
And it's worth it. And they're not taking any equity, right?
Well, it's Generator. So they're taking The good thing is I still own 85% of the company, even though I've raised about $500,000. So we have a real, shot to be able to take this shot to the head with this 6%, but it's a strategic.
You're giving up equity to go get a customer?
But it could, a strategic customer that will help us grow our college partners. And
but you understand what you're telling me, that you value one customer more than 6% of equity. So if that's the case, as the investor, why should I value your equity so high if it's worth what, $100,000 a year in revenue or $6,000 a year in revenue?
So Butler itself as a customer, that could do about $250,000 in revenue yearly, but there's a $100,000 investment. Plus there's a tailored program that's based on selling to colleges, and they can operationalize that business. So there's a bunch of colleges in Indiana that do not have an off-campus housing partner. So it's a strategic fit of how we sell to universities. So when I'm asking investors to invest in a property technology sales, because that will, the self-onboarding, self-checkout, because the property management industry wants this Airbnb/apartments.com customer experience, while the colleges wants the innovative, patented technology that EDU Rain has. We're trying to apply for 4 patents this year. And we need help doing that too, which is another reason why we're trying to go through accelerator.
So you're just making a trade-off, but your equity is the most valuable thing you own in your company, right? And so we're not talking about the next 6 months. I want to be sensitive to time. We just hit the 9 o'clock. So there. But if you're trading something that's going to impact the next 3 months for what will impact, the next 10 years, because hopefully your company exists for the next 5 to 7, up to 10 years potentially. You're just making that trade-off. So I think just stepping back and being like, okay, am I appropriately making this decision? I'm not saying it's a bad decision. It sounds like there's a lot of alignment. Grants, 100,000 investment, potential customer, potentially $250,000, but potential $250,000, and your equity is the thing that matters, right? Or if I were you, contrasting that to what if I went to one of the 5 largest property managers in the student housing space and go get them to invest $100,000. What if I could help them, increase that? Like, what does that impact? Like, you just have to be thinking through like what trade-offs you're making. And, it's hard to make those decisions when you're like, but I need this now, because that's the situation of founders. But think as if you're giving advice to yourself, not to yourself. Like, yeah, Blackstone, that's great. Yeah, Blackstone would be the ideal investor, right? But
And Ian observed that in our case, we offer substantial commissions to our partners, not equity.
yeah, equity is the most prized possession you have. So I just
Right.
would go with a very heavy conversation. Now, is it worth your company dying? No. But also, if you've given up, 35% of the company before your Series A, then 40% of your series before your Series A, no Series A VC might back you ever. So you're just thinking about planning ahead. That could kill you, right? So just being thoughtful. So thank you. I'll be quiet, Bonnie. Sorry.
Oh, no, that was fantastic. And hey, listen, it's fantastic that people are engaged and have questions for you. Somebody in the chat mentioned that they can only connect with you if they're a paid member of LinkedIn. So
Never seen that.
I didn't know that either.
Button and rather than message me, there's the 3 buttons on the right. You click down to connect. I just don't make it that you can connect with me right away, because otherwise founders just click it. So even one more click reduces the people who reach out to me by like 20. So
Okay. And I apologize to Francisco and Zarin that we didn't have the break so I could introduce that you could introduce yourself. Zarin, but Francisco. Francisco is an investor as well. You want to say hello?
Yes, hi, how are you? Hi to all everyone. I have been an investment banker for several years, and now I am investing in VC and private equity. I am from Mexico, so anything that you need in Mexico, you are welcome.
I'll introduce you, Landon. I'll make the introduction. So thank you. Zarin, go ahead. Oh, you're muted.
I know Landon also from Diffuse, actually, so it was great to have him here. So I'm Zarin from Switzerland, and working on few projects. I have a banking background. It was great to listen and get a few learning points. Sorry, I was a bit late. I was coming from another meeting.
So thank you so much, Landon. I will make that introduction. And do you mind if I send Mary your contact information? Or we'll check out LinkedIn. If you have a problem, I will make the introduction. Thank you all. We'll see you in 2 weeks. We have these every 2 weeks. Fantastic, Landon. And I'll see
Mary,
you.
I got your email address, Mary. I think you messaged it to me.
Okay. Thank you.
Fantastic.
Have a great week. 2 weeks, everybody. And we'll see you soon.
Okay. Bye-bye.